We've got an awesome panel here today. I'm Gil, as Jay mentioned, president of Blockchain, Accelerator at Stanford, and partner at Blockchain Builders with Kuhn and Steven. We've got an awesome panel here today with Paul Veradittakit from Pantera, Haseeb from Dragonfly, and Avichal from Electric Capital. And all right, let's get going. So I think, blockchain has had a ton of hype cycles, and most of them I think have been based on hype. Like it's drawn in, the hype cycles themselves have drawn in developers, they've drawn in capital, they've built that infrastructure. But first we have the ICO boom, and then DeFi, then tokens. We're obviously now in a bear market. What do you think is going to drive the next hype cycle? And do you think it's going to be more fundamental value, more like mimetic slash Ponzinomics, or curious what your thoughts are?
Well, I would like to start off by saying I'm going to disagree with everything Haseeb says.
No, he's not.
And that's not necessarily because I actually disagree, but I think it's just way more interesting for everybody else if I just disagree with everything. So I need Haseeb to go first so I can figure out what.
All right, I'll go first. The first thing is that nobody on this panel has any fucking idea what is the thing that's going to drive the next cycle. So I can tell you, I think all three of us were here in 2016, 2017, and nobody had any idea that ICOs were going to be the thing. And when ICOs collapsed and went away, people kind of thought like, okay, maybe it'll be like a renewed version of ICOs, maybe we'll like fix some of the governance problems, maybe we'll make the ICOs more observable and something. And it turns out ICOs had nothing to do with what was coming next. And people did not anticipate NFTs, they did not anticipate gaming, they did not anticipate almost everything that ended up really going huge in mainstream in crypto took most of us by surprise. Now, there are some themes that we could anticipate, right? Like a lot of us were investing into DeFi, back when DeFi was tiny, or just people kind of playing around in their proverbial garages. But a lot of the ideas in crypto are surprising because of the fact that crypto is permissionless. Anybody can build anything. There is no long R&D cycle that takes many years that you can kind of see in advance where we're going, as you can with a lot of other technologies that require much longer R&D cycles. And so more or less, the answer is that we know that something will come, and something will probably surprise us that ends up driving the next bull market, but it will also probably be core to that vector of what crypto is about, which is about permissionless innovation, especially around the concept of money and value. I disagree.
I would like to disagree. I actually think it's pretty clear what crypto is good at, which is it's really capital market formation. It's the ability for people to put money down and organize around that and then move that money around. And it turns out when you let anybody in the world do that, there's a lot of degens in the world, and so then they want to speculate on stuff. And if anybody's read any Carlota Perez, she's an economist, her worldview basically is that that's a necessary property of innovative markets. Like you have to be able to have speculation. So if you look at the railroads, you look at telcos, you look at the internet, that's sort of a necessary process that innovation has to go through, in part because you don't know what's going to work, in part because this is what humans do. The adage that I think, I always think about in this regard is people dramatically overestimate what's possible in 2 years, but they dramatically underestimate what's possible in 10. I'll give you a concrete example. I was a seed investor in a company called Cruise just about 10 years ago. And they had a lot of challenges for the first 3 years. Nobody wanted to give them money. And about 10 years later, you can take a self-driving car around San Francisco. It's like pretty remarkable that they pulled it off in about 10 years. But along the way, there was a lot of money lost. And I think we're probably going through that with AI, and you went through that with AR, VR. So I think it's basically going to be speculation again. Now, what it's going to be speculation on is a TBD, but I think that's just sort of a necessary part of the process here. And I think it's basically capital market formation. It's basically the ability to pool capital, and it's like, have your choice of how that works. But I think that's basically what it's going to be again.
Yeah, I agree on that one, but I think it's probably going to be likely from larger pools of capital than small pools of capital. I think a lot of, again, the last bull market was huge. We started to see a lot of faces that we'd never seen before, a lot of institutions coming in, and a lot of retail coming in and sort of getting burned. And so I really do feel like, regulations could be helpful on this. Bitcoin halving could be helpful. Macro interest rates could be helpful. But I think really institutions kind of coming in and possibly trying out different parts of, DeFi or maybe the ETF, or there's so many intersections, like tokenization. People would ask this, but I think something around the institutional side will hopefully kind of drive the next bull market, I think.
I agree with this. One thought on this, just to give people context. I went back and looked at how big was the 99-2000 stock market bubble, and it was 16.6 trillion in aggregate market cap across the NASDAQ and S&P. And that was in $2,000. So that's probably worth, like 25 or 30 billion today in like 2023 dollars. And crypto last cycle was only 3 trillion, just to put it in context in terms of like what does like a real bubble look like at like a macro scale. We were like 1/8 to 1/10 of the way there in terms of like what the NASDAQ 99 bubble felt like. So I think there's actually probably a long way to go in terms of like institutional capital actually coming in and what that means at scale and the consequences of that. By the way, that's not to say that's a good thing. Like there's
Yeah, to be clear, I think that's a very good thing because like when the dot-com bubble crashed, it affected a lot lot of stuff in the real world.
Yeah.
And crypto has the benefit of one being spread across the world. So there are a lot of different economies that absorbed the crypto crash.
Yeah.
And it was mostly discretionary income.
Sure.
So it wasn't people kind of taking their core portfolio risk, except degens like you guys.
Yeah.
And so the net result of that is that like although there's been a lot of attempt by politicians to kind of pin the tail on crypto caused all this instability, crypto caused the banking crisis, crypto caused all this stuff, it didn't.
Yeah.
And thankfully when the accounting is all said and done, it's like okay, crypto, we got a little ahead of ourselves, but it was mostly not a big deal.
I begrudgingly agree with Haseeb on that one.
And like when you
That
say
means I win.
institutional capital, do you mean like more institutional do you mean like institutional capital specifically, or also like institutional use cases? Like
I think kind of
B2B
both.
type use
kind of both, yeah.
cases.
Yeah, kind of both. I mean, on a dollar-weighted basis, it is the case that a lot of the capital in the world is relatively concentrated in these institutions. I mean, ultimately, it's like pension funds, and so it's actually like some humans' money at the end of the day. But the decision makers of how those capital flows work are relatively concentrated. And so I think it's a combination of that capital, but also the meeting the needs of that capital.
Okay, awesome.
Yeah, and I actually think, Haseeb would probably know a little bit more about this, but like, they have a strong team over there in Asia, but I feel like the institutional capital will probably be driven by outside the US, for obvious reasons.
Yeah.
Yep.
Cool.
Well, actually, yeah, let's move on.
Yeah.
All right, I'm gonna go in a different direction a little bit here. So like we've seen we're in a bear market. There's been a lot of hesitance at investing in and supporting more consumer-focused projects because they've been focused on like degens, and that market's kind of small and got smaller when everything crashed. There's been a lot of focus on infrastructure because of that, of how do we enable these new use cases from L1s, L2s, cross-chain interoperability, account abstraction, like we've seen a ton here. Are you still focusing on new infrastructure investments and ventures? Do you think that perhaps we've started to saturate the number of like new chains, new layers? Is there room for kind of like an endless variety of these, or like how do you think about the infrastructure layer, and are there potentially still any gaps?
So I mean, one obvious way to answer this question is like, do you think that the blockchains we have right now are the blockchains we're going to have in 20 years? And the answer pretty unequivocally is obviously not, right? Everything we have right now is slow, it's kind of broken, the UX sucks. Like, there's no way that we're not going to be able to improve these things in 20 years' time. Now, the question is that improvement going to happen incrementally? Ethereum pushing, meaningful upgrades once every 2 years or whatever? Or is it going to be somebody starting anew from ideas that are more recently developed and building something more foundational?
Right, and especially like now, like is there room right now when we're all targeting the same markets for like new infrastructure? Is that something that happens like once these kind of start to saturate and
right, so
and
I
people
think
build on?
that's the question of saturation. I think it's a difference between the steady state and sort of building along that incline. So what I mean by that is that it's probably true that in 10 to 20 years, there's not going to be 20 blockchains that matter. They're probably going to be maybe 4, maybe 5, something like that, and like 3 that have the vast majority of all the value. However, who is going to be those 3 to 5? The question is still very much unanswered, and there's a lot of game left to be played, especially when it comes to innovating, improving, and iterating on the designs for these blockchains. So when we're looking at infrastructure, a lot of what we're thinking is not necessarily is there room for the 25th layer 1. It's more that does this person have a shot at building something that's going to be one of the most important blockchains in 10 years? And even if the probability of that is low, because it's hard, the market very clearly assigns a very high value to that because they see How valuable is Ethereum? How valuable is the overall pie that we're building for? That's why these things are valuable, not because all of them are going to coexist in 20 years.
I'm so excited to disagree. Okay, so okay, so I think a good analogy here, and the reason I think there will actually be like 25 blockchains in 20 years, is social networks. So what you tend to see is like in the early parts of a market, people can see the opportunity. And so, in 2005, there were a lot of social networks. MySpace and High5 and Bebo and Orchid and yada, 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 right? And most of those are gone now. And then there was a period of consolidation because the market could really only support a small number. And that happens relatively quickly, actually. And then what happens is everybody realizes that there's going to be billions of users of these things. And all of a sudden, you can support a social network with 100 million people. And so you get this massive refragmentation. And so not only do you have Facebook, but had Facebook not bought WhatsApp or Instagram, those would be independent things. They just happen to be able to get those acquired. I think they would have a tough time getting those acquisitions through today. You have Snap, you have TikTok, you have Telegram, you have Twitter, you have VKontakte, you have Line and KakaoTalk. Like you have different networks in India, you have YouTube. You start running through the list and you're like, wow, there are a lot of networks that actually, and there are probably a bunch that I don't even know about, that have like 100 million users. And so actually, if you think that there's going to be 3 or 4 or 5 billion users on this stuff in 20 years, which I think is certainly possible, then I think it's actually more likely that we have 20 or 25 different ecosystems that are each supporting like 100 million, in addition to 1 or 2 really big ones. But I think you actually will end up with something like 20 or 25 ecosystems for regulatory reasons, network effect reasons, technology reasons, human community reasons, just like you did with social networks.
Yeah, I would say I kind of lean a little bit more towards Avichal, but again, he incentivized me earlier before we started.
Clearly some
Yeah, I mean,
There's
I
some
think
off-chain activity that happened before.
I think for me, like there's 3 or 4 interesting general purpose blockchains that could eventually evolve, and I don't know what they're going to end up looking like right now. I think they could sort of change. When I look at an entrepreneur, I try to figure out what are they doing with the new blockchain that's 5 to 10 times better, and so I just don't run across that too often. Some would say maybe Ms. Synaptos had something there, but again, it's really, really rare. Maybe it's more of an ecosystem play versus a tech play that could be sort of interesting too. I do think that there are going to be, I don't know if you call them app chains, you call them other sort of things, but like specific blockchains that could help facilitate like different communities, like maybe it's like, based on geography, based on a use case, based off of like certain things and like needs certain features, validator sets, et cetera. So I'm open to that world where you do have general purpose blockchains and then you have like, segmentations, and I could see probably like, 10 to 20 of them. I think for us, we are not there yet. I think right now people are just trying to figure out sort of general purpose blockchains and how to sort of enhance those ones, or maybe even trying to come up with some new ones. I think the other part is until we start seeing more ecosystems evolve all across the world and more use cases, we're happy to invest into some applications that end up turning into some of those platforms later on too. I think that's one way to go about it, where you come up with a use case, you figure out that like what you're doing, what you're building underneath to support that use case is interesting for a broader set of companies, and then it turns into an ecosystem.
Can you give an example of that? Because I like that a lot.
I mean, one example of it could be, we are early investors in DeSo, and so they started off with BigCloud. Obviously there's pros and cons of how they went about it, but then again, like they said, hey, well, here's something here that could support decentralized social. We can kind of create some of the primitives underneath and create an ecosystem around it, and then build other applications on top. So that's like one example.
Okay, so here's why these guys are wrong. So it's obviously going to be true that there will be a lot of blockchains. In the same way that, there are a lot of social networks, quote unquote, like YouTube has social features, whatever. The reality, though, is that you are not going to have a relationship with all those blockchains. What I mean by that is that there's going to be a very stark difference between commodified block space and block space that is meaningful to you, as in the same way today, Ethereum is more valuable than all the tokens on top of Ethereum, right? You can see very clearly Ethereum has something else special going on. People have a different kind of relationship with it. But there's a lot of block space where you go and you're interacting with some application, and it might be a blockchain, it might not be a blockchain, you don't really care, and you don't have any special relationship with it, you have a relationship with that application that you're interacting with. And you don't really care where, it might be on Polygon, it might be on Polkadot, it might be somewhere else. It doesn't really matter to you, and you have no allegiance to the underlying blockchain or to the token of that underlying blockchain. There's no reason why you would hold it, except if you momentarily need it to interact with that chain. And so I think what you're going to see is this big yawning gap between the commodified block space, which is the vast majority of block space that's out there, and the block space that is really special. And the number of blockchains that are going to have special block space is going to be very small. And it's clearly the case that as we see rollups and application-specific blockchains increase, the total amount of block space will increase, but most of you as users, it'll get abstracted more and more, further and further away from you, to the point where you basically, as a user, never even need to know that that block space is there.
I actually think, I mean, in the short to medium term future, you won't, I mean, I think most users won't even know that they're using blockchain, whether it's like a general purpose one or even like a specific one. I mean, I feel like that's probably what's going to take us to the next, bull market, is really just like institutions and retail not knowing anything and hopefully getting some advantage from it.
Yeah, it being completely like abstracted. Well, I guess to see what maybe if it's like not users but developers, like developers would know. But yeah, I certainly hope that I don't have to like deal with a wallet for like my regular interactions with technology. Cool. On the infrastructure side, like curious, like within the infrastructure stack, do you think that there are any like glaring gaps still? And one of the things that we like to do with the Accelerator is really support companies that are driving blockchain adoption. Many reasons why it's not like massively adopted: user experience, performance, scalability. A lot of these things are being tackled, and I'm actually really excited about kind of where we are today. Do you see any glaring gaps in like the stack from an infra perspective on enabling like use cases for mass adoption?
I mean, mass adoption is hard. I think it's very
Even
hard
just
to predict
adoption.
like the one thing that causes mass adoption.
Even just some adoption.
Yeah, some adoption. Okay, fine. I mean, one thing that I would say, this is not a sexy answer, but it's the first one that came to my mind, is that block explorers suck, especially in a multi-chain world. Right now, basically everybody who's trying to deal with any kind of complex interactions, like if you're going into a roll-up or you're playing with some application-specific thing, your accounting in a block explorer is an absolute nightmare. And so we don't really have good abstractions for thinking about how to keep track of what people are doing in a multi-chain world. Even just like taxes. Like if you try to do your taxes and you're messing around in Arbitrum or you're in Friendtech or you're in somewhere else, it's absolute mayhem. So that's one of the most obvious things that I feel like I'm surprised it's taken this long, and we still don't really have good abstractions for it.
One thing on that, we have 3 teams that are working on like that type of thing. The feedback they keep getting from many investors is like, well, what's the monetization strategy? How big is the market? So then it's like this chicken and egg thing. I'm happy to introduce them to you later.
I'd love to talk to you.
I would also be interested in talking to you.
Sure, why not?
Yeah. But I would
Paul
tell
doesn't like
you
it.
obviously think that the block explorers are perfect.
Yeah.
Curious
turn.
what your
Yeah,
thoughts are.
well, so I think it depends how you define infrastructure. I think if you're talking purely technical infrastructure, there are still some glaring holes. The one that is sort of top of mind for me right now is the sequencer layer for all these L2s being highly centralized. And so something like Espresso, decentralizing the sequencers, I think is actually pretty important in getting that right. But if you define infrastructure more generally as what are the tools that people need to be able to actually meaningfully be able to build here and develop good applications that then the end users will use, I think there's a dearth of good dev tools. I think Block Explorer being one of them. I think institutional custody, MPC, like was that actually usable for the average person on their phone? How do you delegate? Like if you want to participate in an airdrop. Things like it used to be called delegate cache, it's now called delegate. Like, can you sort of hand over, permissions to do certain things to certain assets in your wallets without the assets leaving your wallet? How do you think about multiple types of identity? Like, I think it's one of the really interesting things here is the idea of being pseudonymous, and you can actually have multiple wallets, but it's actually still you. And there's like the degen version of you that's airdrop farming, and then there's the diamond hands version, which is holding the thing, and you're like, I'm never going to sell this thing, and that those identities can coexist in one brain. Like, it's certainly possible, but like all of this tooling that is unique and interesting to the space, I think still needs to be built out and fleshed out so that ultimately people and businesses can use these things. And there's still, I think, a pretty big, to me it feels like if anybody has ever done any research or remembers these, it's like we're in like the 14K modem era, and it's like you have to it's a command line thing, and then you get these like beeps and boops coming from your computer to connect to the internet, and then people don't even understand what the internet is, and they're like, what's a browser? And like, oh, don't I just use a keyword on AOL? We're like kind of in that era. We're still like the tooling for people to be able to do anything is just so rudimentary. But I think of that as infrastructure, and I think that's actually a huge
Awesome
missing piece right now.
Yeah, I agree with you. I mean, again, there's a lot of on-chain data out there and more on-chain data. And then, of course, like being able to pair that with off-chain data and having sort of business intelligence around it, things around identities, goes into a bunch of different applications like lending and borrowing. I think the other tooling that we've seen, a pain point that I feel like hasn't been solved yet, is just onboarding folks into these centralized applications from sort of a KYC, AML perspective. I mean, you have your Moonpage, your Wires, a bunch of other guys, but when you talk to developers themselves and you ask like, hey, like, you know, why are your consumer applications not getting the same sort of growth that they should be, especially if you're spending all that marketing? And they're saying, well, it's because 70% of the users trying to get in are being like not approved by all of these like on-ramp sort of guys that are just like providing, you know, sort of like, hey, is this guy like potentially, you know, risky or not? And so part of it is just like the infrastructure around the banking, part of it's like the risk modeling and that sort of thing. So if 70% of the users trying to get into these decentralized applications are not able to, that's a problem. So to be able to solve that infrastructure, and then of course, I think, you know, mobile, trying to get folks onto mobile, whether it's through Apple, whether it's through Solana phone, whether it's Haseeb phone, whatever it is. I mean, we need to be able to.
Okay.
That was
Coming out soon.
It'll be out soon, but yeah, no, we need.
Oh, we're under NDA, man.
So yeah, I think that's another challenge too.
Awesome. Cool. I like this. I want to touch back on something that kind of you mentioned earlier, which is, you know, we look at like Web 2 in general, and the Web 2 play for a platform or a technology platform has generally been you vertically integrate, you solve a problem for someone, you get customers, you build out the tech, and then you kind of go to adjacent niches and kind of build a platform play around that. And in blockchain, very much we've seen people build a chain, and then like, here's a platform, use it. And the things that it gets used for are like DEXs and lending, and someone else builds that. You mentioned earlier cloud and the team behind that. Like, do you think we're going to see more Web 2 like vertical integration in Web 3 to kind of hopefully gain adoption and solve real people's problems, or are people going to continue building technology and then hope that, you know, with their ecosystem fund, someone else builds something interesting on it?
It's a good bet that people will do more of the same.
Should they?
Yeah, I mean, I think, look, there certainly is a lot more room now to build a kind of verticalized app. Like Friendtech is a good example, right? So it kind of took the same ideas of BitCloud, but did it in a much more user-friendly way. A lot easier to onboard, a lot easier to like kind of make it, you know, a lot of vital components that have made it more successful on a relative basis. Still, it's pretty tiny from the perspective of any kind of Web 2 application that you would consider to be viral. I think, although the pieces are coming into place, and you see this both with social applications, you also see it with gaming, is that it's becoming easier to kind of abstract a lot of the blockchain details from end users. I wouldn't be too glib about dismissing what protocol developers are doing in trying to attract people to their underlying platforms. Most of the time, when an entrepreneur tells me I'm trying to build a platform, I tell them fuck off. Like, it's really hard to build a platform. It's really, really hard. Platform basically means that there is no UX. That's what platform means, right? Like somebody else is going to build the UX. The only place where that really makes sense is when you're building block space. And it turns out that block space, somewhat uncommonly, is so important of a problem to solve and to build in an effective, scalable, usable way that is the one place where it does make sense for people to be doing these platform plays. But if you look at the OG platforms, right? Like take 0x. So those of you who don't know, 0x was like one of the very first big DeFi protocols. They really tried to be a platform. They were like, everybody else, you come and build a DEX on top of this. You build an RFQ exchange on top of this. You build an aggregator on top of this. And it didn't work. And a large part of why it doesn't work is that when you are the person who's building the underlying thing, you are just so much better than anyone who's going to build on top of you. And it's just a general rule that if you're a brilliant entrepreneur and you build this awesome, exciting tech thing, and you're like, hey, come build on top of me, the people who are going to build on top of you are generally less capable than you are. And so usually what I tell entrepreneurs is that don't build a platform, build the thing you want to exist. The only exception to that really is layer 1s or layer 2s.
I unfortunately have to agree. So one way to think about this is there's a really interesting property in a lot of markets. It's sort of a pattern. It's not like a law of physics, but you see this happen a lot, which is if you think about kind of the end user experience, on the one hand is like literally the pixels on the screen that they're going to interact with. Somewhere in the middle is like some protocol or some code that, so that they have to touch to move bits around or connect APIs together, some sort of middleware. And at the other side of it is like the block space. And that's like a CapEx heavy thing. Getting a new chain off the ground is extremely expensive, competing against Ethereum. Like the sheer amount of work that you have to do, the amount of money you have to raise these days to be able to compete at the L1, extremely CapEx heavy, right? The amount of dollars you need. And that actually parallels a lot of industries, right? So AWS is the CapEx heavy, you gotta build data centers. Somewhere in the middle are a bunch of sort of like dev tools, APIs companies, and then on the other end is like Facebook or Netflix, right? They sit on top of AWS, but they own the end user relationship. And you see that in a lot of industries. Tesla is like that, right? And because they own the end user relationship. iPhone is like that, and so on. So like iPhone makes a bunch of, has the end user relationship, and like TSMC and ARM are on the other end, or Qualcomm, right? They have like these fabs that cost billions and billions of dollars to build. Okay, so that's the sort of like the market. If you put a y-axis on that, and you say, well, who captures all the value? Like, where's the money actually made, and what are the consequences of that? You realize that either end of it captures the value, so you kind of end up with this like U-curve. Right, so like if you own the end user relationship, like if you're Apple, if you're Tesla, if you're Facebook, if you're TikTok, if you're Netflix, you make a bunch of money. And over on the other end of it, if you're AWS or if you're Qualcomm or ARM, like these really CapEx heavy things, you can capture a bunch of value. And the people in the middle tend to get squeezed because they don't have pricing power over the other parts of the chain. And so what that means is if you're, let's say, Disney, you can see how this plays out in another market, right? If you're Disney, you're distributing through Netflix. And you don't actually own the end user relationship in the next Netflix scenario, so you're getting squeezed. Like Netflix has all the power in that relationship. So you have an incentive to kind of move up the curve, right? And so this is where you get Disney Plus. They're like, we have to own the end user relationship. We have all this content, otherwise we can't make any money. So we have to own the end user relationship. So you see this play out in all sorts of other markets. And so I think the way this plays out in crypto and blockchain is if you're somewhere in the middle, if you build a protocol like a 0x, you have one of two options. You either have to try to move towards the block space side of the curve. You have to say, I'm going to build it my own L1 or an L2, and the L2 is going to masquerade as an L2 and has incentive to try to become an L1 ultimately. Or I have to move up this side of the curve and own the end user relationship. And so I'm going to build an interface, right? Like you see Uniswap kind of doing this. It's like I have to own the interface.
Uniswap, yeah.
Yeah, right. And so there's sort of this like natural. It's almost like an emergent property of like the game theory of who captures value and how, and who has like pricing power over whom in a market structure. That you sort of I think get this emergent behavior.
Yeah, no, I agree with these guys too. I mean, at the end of the day, I mean, you see everybody trying to get as close. I mean, 1inch is doing the same thing too. Everybody's trying to get to the wallet side of things, and then just kind of move back down. But it is tough though. I mean, we've invested into a bunch of, I guess you call them developer tools. I'm on the board of Alchemy, and we've, they've gone out there, and I guess with these developer tools, you just go and solve one problem and solve it really, really well, and then try to then expand over to other things that are a little bit more sticky. Talk about things like APIs. I think a lot of developer tooling are trying to get to different customized APIs for folks, and then of course trying to get into the transaction layer. But at the end of the day, I mean, everything just kind of either moves closer and closer to the users or back down to block space.
Yeah, I think I like the analogy of these platforms basically like bought their vertical integration. Like they just acquired it because they needed it. Yeah. Cool. I like that you brought up Alchemy. I mean, we're seeing like there's dev tooling, there's enterprise. Kind of like blockchain companies, and at the same time we're also seeing like Base launched without a token. Curious about like how do you guys think about tokens themselves, and like are they necessary? Do they always help, or are they often just a distraction, especially in the current regulatory like climate within the U.S. And how does that ultimately impact like the business model for venture capital and blockchain if there are potentially are not tokens?
Very interested to see what Haseeb's going to say.
I'll go last on this one. Why don't you go to start?
Okay, I'll go first. You just have to disagree. Okay, which side do I want to take on this one? I think I actually think tokens are very interesting. I think not everything needs a token, but I think if you don't need a token, it's unclear to me that you should be building on this tech stack, because I think that's like a proxy signal for are you doing something novel and interesting that could not have been done otherwise. And if it doesn't ultimately need a token, then it's unclear to me why you would take the cost and the pain of building on this tech stack in this way. Like it's just so much harder to do it this way. And really what the token is doing is trying to create an incentive alignment between a bunch of mutually distrusting parties who don't necessarily know each other, and an interface to create alignment for those people. And I think there are a lot of effectively marketplace types of problems that can be solved using that sort of alignment. Now you have to be smart about how you do the alignment. If you do the alignment in a bad way, you create bad incentive structures. And that's actually, I think more often the case than not. I think people are not thoughtful enough about how they're doing the tokens themselves. But I think ultimately that's actually what makes these things interesting. I don't have a great term for it, but it's, to me, it's a new model for human organization at internet scale, and that's what is interesting about it. And so if you're not taking advantage of like that new thing, then like what are you doing? A proxy here, just by analogy, would be like, the internet made it really easy for people to create content and created user-generated content. It's like a participatory global ecosystem for content creation and distribution. If you're not really taking advantage of user-generated content, like, what are you doing, right? That's like the thing that the internet is good at. And so, like that's why the old world media companies where I'm gonna make a blog and like put it on the internet and it'll be scalable and a good business. You're like, okay, that's like an okay business, but you're like not Facebook or Twitter or YouTube or TikTok. Like that's what made the internet interesting. And I kind of think of tokens similarly.
I guess, do you think you need your own token, or can you use another token? I mean, ultimately, like blockchain is also, it's building decentralized applications, decentralized infrastructure. Like, does that need you to have a net new token, so to speak?
It's a good question. I think in a lot of cases, yes, but that doesn't necessarily mean that the token will capture value. And I think there's sort of like an over-indexing on the token is the value capture mechanism, but I think that the token could exist to create alignment, to offer people the ability to govern these things, and but it's not necessarily an economic instrument.
Cool. Paul?
Yeah, I think you can build something and not have sort of a clear idea of what the token is going to fit and what it's going to do. At the end of the day, though, I think there's certain types of projects, certain type of playbooks out there where, a token can make a lot of sense. Again, it's the decentralization of economics, it's the coordination mechanism, and so I think at the end of the day, I mean, especially in a bear market where there's just like less noise out there, I think you just put your head down, you build, you try to find product market fit, and you can reevaluate later on. Once you actually have product market fit, I think it also, from other perspectives, it makes a lot of sense to kind of get product market fit first and then figure out a token. But I don't think you need to go in there and just say, hey, like this is gonna be a token project and this is what the token's gonna look like. But it's good to at least have that mentality in mind. But I think you just go out there and just find product market fit first. I think that's the key.
Yeah, I think we've spoken about this like in another chat of the importance of product market fit first. Otherwise, you have a whole bunch of users and token holders that aren't actually the people that you're creating value for, and then you're kind of screwed with your project.
You actually need to know how your product functions and who are like the players you want to coordinate around.
Yeah, so I think that definitely agree with that. I mean, this is the whole idea of progressive decentralization, which is you start with finding the right product, and then you figure out how exactly do you decentralize it. Going back to what Avichal said about, look, if you don't have a token, what the hell are you doing in the space? Like, go back to TradFi or whatever. I think it's actually a very deep question.
Yeah, I actually don't know the.
It's actually a very deep question. Is the main thing about crypto tokens? Is that the main thing? I think the answer is no. But it's what would I say? What we look for when we're looking at investments is there a coherence between what somebody's building and how they're monetizing it? And that's what I care about more than is there a token or is there not a token, right? So if somebody's building developer tooling, probably that doesn't need a token, and if it has a token, it's probably making the product worse. And if they're building an Oracle network, probably that thing should have a token, and if it doesn't have a token, probably I'm going to be less likely to trust it if it's just there's some company that's spitting stuff onto a blockchain. And so there's one thing that I often look back on is if I look back at our very first fund, which was launched in 2018, and I benchmark the returns of the tokens versus the equity investments, they're actually very close to each other, which is a little bit surprising because I think most people think that the tokens is where all the money gets made, right? So their assumption is that, well, what VCs do, they buy tokens, they dump them on retail, ha ha ha, and then we all go home and retail gets fucked. And that's not really, I think that's not really true. In the short term, it looks like tokens make more money. Why? Because tokens are marked to market. Every single day there's a price goes up, and it looks like, at any given moment you look, it looks like the tokens are outperforming. The problem with equity, it sort of goes up as a step function, right? So you wait for a while, and then the seed round, and you wait for a while, and the Series A. Any given moment, it looks like the tokens are outperforming. But I think when all is said and done, especially because there are a lot of games that get played with token valuations, when, not to name any names, that might rhyme with hurled coin, you have a very small amount of float that makes it look like the fully diluted value is really big. The investors look like they made a lot of money. And I think this stuff can often be very deceiving when all is said and done, when an investor actually exits and comes out with cash, right? Like very commonly said in venture, you can't eat IRR. Eventually you have to turn whatever investments you've made into cash. And if it doesn't happen, guess what? It didn't work. You aren't some brilliant investor if you can't actually get the cash out at the end. And so all that is to say, I think the thing that matters in the end is not whether it's a token or equity, but whether or not you're solving an important problem. And if you're solving an important problem, there will be some way for what you're building to capture value if you construct it in the right way. And I very firmly believe, even though sometimes it's an unpopular position, that the ultimate thing that matters is not the form in which you monetize, but the scale of the problem you're solving.
Awesome. That segues me perfectly. Thank you.
Amazing.
Talking about what problems we want to be solving. So earlier we spoke about infrastructure and how a lot of the challenges and frictions in blockchain are being tackled, right? From there's a ton of projects that are kind of working on the account abstraction principles that are now live that you can use. Like the interface they're getting, friend tech, it's janky, but you can use it almost like an iPhone app-ish. You have low gas fees on scalability. Are you starting to look again at applications, even in this market? And within that space, are you looking more the B2B side or the consumer side? And when I think about 2017, some of the big L1s, like Pantera and Stellar, we don't really hear about them now, but they're still kicking. And they just went to the B2B space because that's where there's reliable money that's not based on speculation and just bribing your users. So curious, how do you think about that? Do you think we are going to start, or more probably, are you looking at investing now in applications again, and kind of in which direction are you looking?
So I'll go first. So we're always looking at applications. I mean, we always look at everything, just because we're crypto only, so we don't really have anything else to do. Now that being said, it's certainly true that there's more of a skew right now towards enterprise and B2B, in large part because they're buying. Mm-hmm. And if you look at consumers right now, consumers kind of don't want to mess with crypto at the moment. There's relatively low appetite. Trading volumes are at a local minimum over the last couple of years. There's occasional things like friend tech that pop up. Unclear yet whether this actually has staying power or if it's just kind of a couple weekend phenomenon. For the most part, we are, as an industry, we're still waiting for real breakout applications. The biggest things right now that are getting that kind of energy are just crypto trading, and then a few things that are mostly represented in emerging markets, right? Like some of the play to earn games that, believe it or not, still exist and still have a decent number of users. Things like Chingari, which is big in India, which is built on Aptos. It's like a social video thing. There are a lot of these kind of one-off applications that do use blockchain, and there is some, it may be abstracted a lot from the user, but there is some element of a user-facing application there. But they're right now still pretty thin. So I would guess that for a lot of the consumer-facing applications, it's going to be teed up for the next bull market when consumers are willing to take risks on new products again. But right now, the average consumer, just think of yourself. How many crypto applications have you played around with in the last year, right? Is it more than 5? There's a good chance for most of you the answer is no. And if that's the case, that you can just multiply that out, except with the fact that you guys are the most selected to be the people actually playing around with these applications. So I think it'll be some time again until people get really excited about trying new things on the consumer side, whereas enterprises, they're always playing around with this technology.
Yeah, I would agree with Haseeb on that. I think we're still really interested in consumer applications, and there's not a lot of entrepreneurs right now kind of wanting to go in with great backgrounds on the consumer side. So when you come across one that you think could do something, I think it's a great time to back those guys, because again, it'll take time to build out the product, test the users, and just kind of prepare yourself for the next market in terms of just the infrastructure needed to kind of get things going, and just trying a lot of stuff. Great time to be marketing too if you're doing something on the consumer side, right? I mean, no one else is marketing it, so this is a great time to be building. Love founders that have some background in that, and definitely open for business to doing that kind of stuff. But outside of that, it's mostly B2B. I mean, I'm seeing some early traction on like B2B enterprise NFT stuff. I'm starting to see things around tokenized real-world assets, around treasuries, of course, and other things. And I think things like what, I think Circles, and other companies on the payment side of things are trying to figure out how to, enable much better cross-border infrastructure. PayPal, of course, with their stablecoin, I'm sure that's going to be around the payment side of things too. So I think there's a lot of things on the B2B side.
Sweet.
Well, I think it depends on how you define consumer, right? Like, is the US dollar a consumer product? I would assert yes. And there's like $125 billion of USD on chain now. And most of that is used internationally. And you can look in certain markets, I was just looking at some data. It's something crazy, like 30% of transactions in certain Latin American countries under $1,000, like Venezuela and certain countries, or Argentina, 30% of transactions under $1,000 are now done on crypto rails with USDC and USDT, which is wild. There's actually one of my favorite stories of all time. If anybody hasn't read any David Foster Wallace, you should go read some David Foster Wallace. But he gave a speech at Kenyon College maybe like 20 years ago. And it's a longer speech, and you should go listen to it. It's about, not trusting authority and yada, yada. But he tells a little parable in it of two young fish are swimming in a river. They're swimming upstream. An older fish is sort of swimming downstream. And the older fish turns to the younger fish and says, "Hey, boys, how's the water today?" And the two younger fish nod back, and then they keep swimming. And then after a while, one young fish turns to the other young fish and says, "Hey, what's water?" And it's a parable about being able to see the water, right? That's sort of what you get with experience and wisdom. But I kind of think the US dollar is kind of like financial water. Like, Americans don't really see the water, and everybody else in the world sees the water because they have to. And so I actually kind of think there is a consumer application that like tens of millions of people are using already, and probably like 3 billion people want, which is the US dollar, and that's already here. And that is like a pretty killer wedge in my opinion, and I think it's actually not only a killer wedge on the adoption side, but actually from the regulatory side, because all the regulators understand in America that the US dollar is a tool for national security. Like, the reason that the US can do sanctions is because everything runs on the dollar. And this is like, this is Eurodollar 2.0. This is like, next level SWIFT, using like 2023 technology instead of 1973 technology. And the regulators are starting to get that, which is why you're seeing bills passed, out of the House Financial Services Committee that are pro-stablecoin. So yeah, I think it sort of depends on the question of how you define consumer. If you think the US dollar is a consumer product, I would assert that there's already a consumer use case, and it's probably the world's biggest use case. I will also say one of my favorite things that I've really come to believe over the last 5 years is Elon Musk has this, I'm calling it Musk's Law. I don't think he calls it that. But it's basically that the most entertaining outcome is the most likely. Right, if you believe we live in a simulation, then that's like certainly the case. But I think it's maybe an emergent property of social media somehow. But it is kind of funny to me that like the killer cryptocurrency might be the US dollar, given where all this stuff started.
Yeah.
That's like kind of hilarious that's actually maybe what like makes regulators okay with it, and like that's actually what a couple billion people will use is like dollars on Ethereum. Or maybe even, I don't know if anybody's seen this data.
On Tron.
Yeah, I was just thinking this. It's like, I don't know if anybody's seen this, but like Tron turns out to be the cheapest way to move dollars around. And so you can look at like USD volume between certain countries, and it just runs on Tron, which is hilarious to me.
That's
The
hilarious.
most amusing.
Yeah. So anyway, if you think of the US dollar as a consumer
Yeah.
tool, I actually think we already have consumer adoption.
Awesome. Thank you. I do, and it is sad that that's like literally the antithesis of what.
It's so funny to me that that's actually like the killer use case is the US dollar. I love it.
Circle, good entrepreneurs pivot. What a find on that one.
All right, last question. What's a contrarian position you think you have on this industry?
That I think I have,
You think,
but
you
don't
might-
actually have?
No, that you, you think that it's contrarian, but it might not actually be.
All right, I'm going last.
I don't even know what I believe. Like, this is it's wild. That's what's so fun about this. Like, I was my background's mostly as an entrepreneur, and I was doing a bunch of angel investing before we started Electric. And part of the reason I moved into this space is because by like 2017 or 2018, you could look at a fintech deck or a marketplace deck for some SaaS thing or whatever, and you could just like get rid of the team, and you could get rid of like the logo and the branding, and you look at the deck and you're like, I think this is gonna work or it's not gonna work, and that's super boring. And that's what's so, but that was not what the internet was. Like when I was doing my first company, right, in like 2008, it was not at all clear. Like literally, if you go back to being in middle school or something, right, 20 years ago, there's probably a list of stuff if you went to your school, like a poster on the wall that said like, please do not do these things on the internet. Like, please don't talk to strangers. Like, please don't meet a stranger in real life that you met on the internet. Like, never, ever, ever go to a stranger's house that you met on the internet, right? There's like a never, ever get into a stranger's car on the internet that you met on the internet. And literally, those are all of the biggest businesses on the internet, right? And so, to me, that's like, again, just hilarious that that's what ended up being the biggest business on the internet. But there was a period of time from maybe like 2000 to like 2015 where as an investor or as a founder, you're like, I don't know if this is the stupidest thing I've ever heard or this is the most brilliant thing I've ever heard. And that's what crypto feels like to me right now. Like, you just look at some of these things and I'm like, I don't know if this is like the stupidest thing I've ever heard or if this is actually genius. And it's just, that's like what's so magical and interesting about it, which is why I'm like, I kind of don't know. Like, I could believe one thing today and I could believe the exact opposite after meeting a founder today. And I'll just walk out of here and being like, yeah, I guess I now believe the exact opposite of what I believed an hour ago. And so I don't like, that's why it's hard to even answer that question. It's just like, it's so hard right now to even know. But that's what's fun about it. That's what's so interesting about this space.
Yeah, I mean, I've been in the space now for 10 years. It's been crazy. I'm about to hit a decade. And I came into this like getting excited about Bitcoin, store value, and crypto being used for payments in emerging markets. You know, my background is from Thailand, so a lot of just unbanked over there. And so being able to sort of bank the unbanked, I thought was just awesome using crypto. Own your own keys, own your own money, decentralized finance, et cetera. And so I've been surprised throughout the years how big this industry has grown. I think the one thing that stays the same is the markets that we're tackling are just huge. And the number of markets that we're tackling just continues to grow and grow, especially with all these different blockchains and stuff like that. So I feel like everything that I try to think about that's different from other people are already thinking of it, maybe just because I talk to so many people. But like, I get excited about Bitcoin again, Bitcoin infrastructure. I'm excited about consumer. I still want to find killer consumer applications. I know a lot of people are staying away from it, but if you're doing something on the consumer side, I'm excited.
All right, maybe I shouldn't have gone last because my answer, I was trying to think of like what's the real answer of something I think is contrarian that like I've gotten into arguments with people about. And so mine is a little bit of a downer, but whatever. So I think that, so like if you look at the internet, basically in like the 80s and 90s was when almost all the important ideas were invented. And everything after that was more or less implementation details. But like everything important about the internet, about encryption, about peer-to-peer network, or like networking, IP, TCP, IP, all that stuff was basically invented 80s and 90s. And everything else was kind of just doing it, right? I think we may have crossed that threshold for crypto already. That basically like 2018 to 2020 was that period where we basically invented almost everything. And everything from here is mostly implementation details. I don't know if that's true, but it's an idea that I've been arguing with a lot of people about, and I think it might have happened.
I like that's actually really uplifting. Why is it depressing? That means that we might actually get something useful out of all this.
It's uplifting, it's uplifting if you're an entrepreneur, and it's not uplifting if you're a researcher.
Fair. I mean, that said, the iPhone was invented in the 2000s, which I would argue like made the internet.
It totally did. So there are
accessible.
inflection points with respect to usage and platforms, but the iPhone, like in principle, the iPhone did not invent anything that was not in principle possible, right? There were cell phones way before then. Some of them were connected with the internet. The form factor sucked, and I think that will be true for crypto, is that it may well be that in 10 years, everything that we see is recognizable. Everything is like, oh man, somebody was doing that in like 2021, but it just sucked and they didn't get the form factor right. And I think it's possible that we've already cleared that window when all the important ideas were invented.
Awesome. All right. Well, I'm over time by a couple minutes, but guys, this has been awesome.
Thank you so much.
Hey, thank you so much.
Thanks, everybody.